Hello, what is going on, everybody? Welcome back to the second video on the channel. Today, I'll be delving into the world of options. And if you have no idea what that is, don't worry about it because I'm going to explain it to you super simply and in a way that it's going to be so crystal clear. You can be like, hey, why don't I do this? Now, I do have to remind you, I am experimenting and I am learning. I'm a beginner. I'm trying to see how investing works out. So that being said, I'm investing money that I'm okay with losing. Obviously, I don't want to lose it, but if it does happen, it's not the end of the world for me because I do have a full-time job. So if you want to invest, be sure to do it safely. Make sure you have an income, and also know that nothing I say is financial advice in any way possible because, like I said, I'm learning, I'm experimenting, I'm playing around, I'm showing you my analysis, how I trade options, what I do to prepare and learn, and, you know, make some money during the week with them. So without further ado, let's not waste any more time. Let's get right into it. Okay, we have to get the whiteboard out for this one because before we go into options, I want to make sure everybody has a basic fundamental understanding of the stock market as a whole. So you can do something called longing or buying a stock. This is what most people think about when it comes to investing. Oh, buy it when it's low and sell it when it's high. Yes, this is when you are bullish on the stock, meaning you think it's going to go up. So you buy 100 shares, each worth at the current price, which is $10, and now your total investment is going to cost you $1,000. Now, if the stock price goes up as you predicted, and it goes to $15, now each of your 100 shares just went from $10 to $15, which is a $5 gain for 100 shares, giving you a $500 profit. In other words, 50% gain because it went from $10 to $15. But now if it went down to $5, your investment lost 50% of its value because each of your 100 shares were valued at $10 and now worth $5. So you lost $500. Now, on the flip side to this one, we have something called shorting or selling a stock. This is when you are bearish on the stock and you think it's going to go down in value. But I know you're all thinking this question right now. How do you sell a stock that you don't own? Well, let me explain to you. The price still costs $10 and you are going to borrow 100 shares from your broker. You tell your broker that I'll give you 100 shares back, don't worry. And your broker doesn't care about the price he gets them. He just wants them back. So you borrow 100 shares, you sell it into the market, each at $10, and you take $1,000. But remember, you still owe your broker 100 shares. So now, as you predicted, the market goes down to $5. And you buy 100 shares back. But now, those 100 shares only cost you $500, and you sold them for $1,000 beforehand. So now you made a $500 profit. In other words, you are 50% up if it goes down to $5. But if it went up to $15, you will now have to buy back the shares at $15 worth, which is $5 for every share more that you borrowed, which is $500 lost. Okay, so now that we understand how the basics of the stock market works when it comes to buying and selling stocks, we can move into options. Now, to trade options in Robinhood, all you gotta do is go to the stock you want. I'm picking Palantir because it got wrecked along with the entire market and I want to get some options for it. So I'm going to click on Trade Palantir Options. Now, there are different types of options you can buy. There's a buy call, there's a buy put, there's a sell put, and a sell call. I'm going to be dealing with buy calls in today's video. So the other options I'm going to be exploring other times. Today, I really want to focus on this because this is what I plan to do for this coming week. And let's get into it. I'm going to have my good friend ChatGPT here explain how buy calls work. Now, when you buy a call option, remember, an option is a contract which contains 100 shares of the stock. You are betting that the stock price will go up above a certain price called the strike price before a specific date known as the expiration date. And here's how it works. What you're doing, you're buying the right but not the obligation to purchase a stock at a specific strike price before the expiration date. Now, this is an extremely important point. You're buying the right but not the obligation. See, I'm going to explain why this is so important, but don't forget it. Now, why would you buy a call? You think the stock price will go up soon. You're bullish on the stock. If the stock price goes higher than your strike price, your call now becomes valuable and you make profit. How it works, you pay a fee called a premium to buy this call option. Now, here's an example. A stock is currently $50 and you buy a call with a strike price of $55. expiring in a month. If the stock goes to $60 before the expiration date, your call is worth the difference. $60 minus $55, which is $5, your profit. Once the stock goes above your strike price, plus the premium you paid, you start making a profit. For example, you paid $2 for the call in premium, and the strike price is $55. So now your break even is not going to be $55. It's going to be $55, which is the strike price, plus the $2 you paid in premium. Now, in order to start making profit, anything above $57 is your profit. If the stock goes to 60, you profit $3, which is 60 minus 57, $3 for 100 shares, $300 in profit. Now, what do you risk? Just the premium upfront money you pay in the beginning. So, key points. Buying calls is betting the stock goes up. Risk is the premium you pay. Reward, there's potentially unlimited amount of gains you can make. And I'm going to show you why right now in Robinhood. So let's walk through an example. Let's say I think PLTR is going to hit $67. So I click on it and I just want to show you guys what I mean by the whole break even, profit, how it all works. So this contract has a strike price of $67, but my break even price is $69.34, because remember, to get a contract you need to pay a premium. So the premium here is $2.38. So $2.38 over my strike price is where my break even would be. That means you recoup the money that you put into the contract. But anything above it, that's all profit. So now if the stock goes to $70.68, you made $129. Remember I told you to remember you're buying the right but not the obligation. So let's say I bought a stock at $15 and it went to $100 in 1 week somehow. I might want to actually exercise the contract, which means actually buying the stocks at the strike price. So I can buy all 100 shares at $15 even if it went to $100. So obviously that's a big loss for the person selling it, because that's just unfortunate. It'd be like that. But for the buyer, it's really awesome. However, if I think it's going to go down after a big up, like I think it's going to go back down to 15. There's no way. It's not going to last. So I decide to sell the contract, not exercise it, sell the contract itself, because the contract has more value because it's past your strike price. So now I can sell it and get the profit of the contract itself without shelling money to actually buy shares. Because again, I don't want to buy the shares. I don't want to own the shares if I think it's going to go down after it. So I think that PLTR is going to go up. How much? Let me find out. I'm going to show you guys my technical analysis. This is what I do. I do it in TradingView. It could be this is complete bogus analysis. I don't know. I am doing what I do, how I analyze charts, what I see, indicators I'm using, but I'm gonna just walk you guys through what I do. Like this is what it's all about right here. Now I have this horizontal line right here and I'm gonna tell you what this is. So what I've learned is that there are two very important things when it comes to technical analysis, called support and resistance. See, support is where it seems that the stock is bouncing back up. There's a lot of buyers ready to buy at that level. The opposite is called resistance. So this right here is a resistance level, meaning this is where the stock generally sees a lot of people selling off, hence being stopped out at that point. And these are very important to keep in mind because sometimes you can spot breakouts. See, I put this line here as support maybe a few weeks ago, and to like literally I think a few days ago was the first time it broke through. But this could be called a false breakout from what I understand. Like it could just be like it's testing it, but it's going to go back up. And we see that it did recover. I am kind of on the side that this is going to go up because these candles right here, to me, it looks like there's a lot of indecision in the market. But we do see that it did already test the resistance level I had. And I don't think it's going to go past it. However, it's important to see this now. See, I'm doing this with you guys. I'm going through what I'm just thinking in my head right now. So right here, it has its peak, right? This is the highest PLTR got to. And it then set a low right here. And following that low, it set a lower high and a lower low. So when a stock is going up, it's typically gonna set higher highs and higher lows. That's what we see right here. The stock is setting higher highs, low and higher lows. Then next again, it's setting higher highs and higher lows, higher highs, higher lows, and then again higher high. And now this is a lower low, lower high, lower low. I hope that made sense. I just said the same words many times, but I hope you followed along with that. And I don't know if this is going to indicate that Palantir is on a downtrend. Because honestly, I think Palantir is a good stock. And I do think we're in a bull run. And once Trump is in office, it's going to do great. I would say, let me see the type of percent I can foresee. Not some profit or something, guys. I'm just doing my analysis, if anything.
Kloski, analysis.
It's at 67.25 right now. I think it can probably see 74 by the end of this week. So back to buying options. Let's say that was my whole analysis. Obviously, guys, I'm making it super short in the videos. I can't make an entire thing of like 3 hours long, me analyzing stuff. Maybe I will in the future if that's what you guys want. So I think Palantir is going to hit $74. I'm going to give myself $2 being wrong because that's just me. I'm still learning. So I'm going to say 72 is going to hit. So anything above a $71 break even is something I'd be interested in. Because if I think it's going to hit $72, then I want to make sure I get at least 50 cents or $1 in profit. So if I go with a $70 call option expiring January 17, it's going to cost $1.15 per share, which is $115 for the whole contract. As you can see, my break even is going to be $71.15, and if it hits $72.50, I now doubled my money, a little more than doubled my money if it hits $72.50. Now I'm going to add this to my watch list because market is closed right now, and it could be I'm gonna buy this unless I see like pre-market something drastically changes, and like if I see Monday at 8:30 when pre-market opens, this gets broken through again, then I'm not gonna buy this option because it could be it's heading downwards again. But if it goes up, it's very likely I'm gonna buy it like the second the market opens, because contracts are super volatile and time sensitive. So if I think it's gonna see a big peak in the morning, it might hit 75. I'm going to sell my contract. I'm not going to exercise it. I don't want to own Palantir. Like, I do have a few shares, but right now I don't see how much of a profit I can make even if Palantir hits $90 this year in 2025. So I want to get options on it. So it's going to have a peak on Monday to like $76, $75. I sell the contract for its value. I don't care about exercising the contract, which is buying 100 shares. So let's go back to this. So there's a lot to learn right here, and I'm definitely going to go into more detail on another video with the Greeks as I learn what these are, because these three right here, to my knowledge, are extremely important, as well as things like implied volatility. I don't know if you guys understand, but when you buy options, I think technically you want them to be in more volatile markets, especially if you're looking for those big ups to sell the contract at that value. Again, I could be so wrong about this. I'm just letting you all know. Okay, so this happens to be a very aggressive way to do options. The one I just added to my list expiring this week, it's a little risky for someone like me who doesn't have enough knowledge to be certain in this. So if I want to be a little safer and go out to, let's say, February 7th, but now look what happened. That $70 call option is now $4.40 per share instead of $1.15 per share. You see the difference that the time makes, because now there's more time for the contract. So you have to pay more because it's more likely to happen. Now, to get a lower premium, you have to go further out. So let's see if I take a $82 strike price with a $83 break even for a $1.44 premium. I'm gonna add this one to my watch list as well. I don't know if I'm gonna buy it. We're gonna see how the market's looking. I hope you guys kind of understood what I did today and the options I got. I hope you understood what buy calls were. And if you have any questions and if you want to learn more about this, I could definitely make more videos. Put it all in the comments, and I hope you guys enjoyed. Don't forget, Stay tuned. Stay hungry. Get that money. I'll see you guys Monday, 9:30 a.m.